coronavirus pandemic has created economic uncertainties worse than the 2008 crisis and even the Great Depression. Experts believe it has the potential to accelerate investment into sustainable options in the post-COVID-19 world. Sustainable investing is an integration of environmental, social, and governance factors. The pandemic has revealed both staggering social inequalities and administrative lapses globally, factors that power sustainability movements. Jean-Xavier Hacker and Hugo Duberg of JP Morgan believe in the long run, COVID-19 could prove to be a major turning point for ESG investing, as environmental risks are viewed as an important wake-up call. Evidence suggests ecological imbalance by human disturbance is a major sustainability issue. During the financial crisis of 2008, UN Global Compact and the UN Principles for Responsible Investment recorded increased engagement in responsible investment initiatives. Not only in 2008, economic weaknesses experienced during 2009, 2015 and 2018 also highlighted that downside risk in sustainable funds was substantially lower than traditional funds, as per Morgan Stanley. This year, US-listed sustainable funds are seeing record inflows despite weak sentiments. According to Morningstar research, sustainable mutual funds and exchange-traded funds had inflows of over $45 billion globally in the first quarter, while the fund universe had an outflow of over $380 billion. Therefore, efforts made by companies to address risk and look at long-term well-being become an integral part for long-term profitability. COVID-19 might also be challenging shareholder primacy, according to JP Morgan, while moving towards a trend of stakeholder capitalism. As companies are struggling to meet their short-term financial requirements, short-termism might disappoint over 88% of people who want to work for companies that reflect their values, according to a report by PwC. The year 2020 has brought the importance of investment goals through greater integration to the forefront. As per Lav Chaturvedi, ED and CEO at Reliance Securities, the Nifty ESG index has been outperforming the benchmark Nifty for more than a year, and ESG stocks should continue to see traction post-COVID-19. Sustainable funds in India have attracted more than $500 million in the January-March quarter. Sustainable or ESG funds in Asia, excluding Japan, witnessed an inflow of over $900 million during the quarter under review. In the June quarter, reports suggest 5 out of 6 ESG funds in India added up to 27% assets under management. Millennial investors were already looking at a more holistic approach, as they are twice as likely to invest in companies or funds that target specific social or environmental outcomes, according to a report by EY. But Fitch Ratings has noted in a review that most coronavirus rescue financing programs are not structured for long-term debt sustainability, violating ESG objectives. It is important to note that human capital management, that is ensuring the well-being and safety of employees, is a prominent ESG-driven lesson from the pandemic.